All right, today we are going to tackle one of the most foundational and honestly, one of the most mind-bending concepts in our whole economy. It's called fractional reserve banking. It is the hidden engine that powers pretty much everything. And in this explainer, we're going to break down exactly how it all works. So let's just start with a really simple question. When you think of where money comes from, what pops into your head? You probably picture a huge government building, right? With these giant machines just printing stacks and stacks of fresh banknotes. But what if I told you that's not where most of our money is born? Not even close.
Yeah, the reality is, it's way more surprising. Sure, central banks create the physical cash and digital reserves. That's stuff you see on the left. But most of the money in our economy, I'm talking about the money in your bank account right now, that's what's on the right. It's called commercial bank money.
And look, this isn't some fringe theory. This is the fundamental reality of how our system works. Those digital numbers you see in your bank account, that's commercial bank money. And the total amount of it out there just completely dwarfs all the physical cash that exists. So to really understand how that's even possible, we've got to go back in time. So let's rewind the clock way back to a time of gold and silver. We're going to look at a pretty simple but really clever idea that basically gave birth to modern banking as we know it today. Okay, so it all started with goldsmiths, right? These guys had the strongest vaults around, so naturally, people would pay them to store their gold for safekeeping. In return, you'd get a paper receipt. Pretty soon, people realized it was way easier to just trade the paper receipts instead of lugging around heavy gold. Those receipts, they basically became a form of money. And then came the big aha moment. The goldsmiths looked around and noticed that most of the gold just sat there. People rarely came to claim it all at once. So they thought, hey, why don't we lend out some of this idle gold and charge interest on it? And boom, that was the birth of fractional reserve banking. And that little story brings us right to the formal definition. It's a system where banks only have to keep a fraction of the money that's deposited with them on hand, as a reserve. And the rest, well, they can lend it out. This simple mechanism has a massive consequence. It literally allows banks to expand the money supply. Okay, so let's really dive into this. Let's see exactly how this money creation machine works in the modern world. It's kind of like a loop, but trust me, once you see it laid out, it'll all click into place. So here's the basic process, what we're calling the money creation loop. Step 1, brand new cash gets deposited into a bank. Step 2, the bank holds on to a small fraction of that, just a little piece, in reserve. Step 3, it then issues a loan for the rest of it, and this is the key. Step 4, that loan creates a brand new deposit, which expands the total money supply. Okay, so let's imagine you deposit $1,000 of cash into Bank A. Now for the bank, that cash is an asset on their books. But your deposit is also a liability, right? It's money they owe back to you. So at this point, nothing's really changed. No new money has been created. The balance sheet is perfectly, well, balanced. But of course, the bank isn't just going to let that $1,000 sit in a vault. Let's just say, for this example, that the reserve requirement is 10%. That means the bank has to set aside $100 as a reserve. But now it has $900 in what's called excess reserves, and that is money it can lend out to start earning some interest. And this right here is the magic moment. Bank A gives a $900 loan to someone, let's call her Jane. Now look at the asset side. That new loan is an asset for the bank, something Jane owes them. But here is the absolute key. The bank doesn't hand Jane a bag of cash, it simply creates a brand new deposit for $900 in her account. You see it right there on the liability side. Poof. Just like that, the money supply has expanded by $900. So let me just repeat that to be super clear. Banks don't lend out pre-existing money that's just sitting there. They create new money, new deposits, through the very act of lending. Now that $900 in Jane's account can be spent, maybe gets deposited in another bank, and the whole cycle can start all over again, multiplying that initial deposit throughout the entire economy. It's an incredibly powerful system, but it has a built-in vulnerability. You see, because if a bank only holds a tiny fraction of its deposits in reserve, well, that creates a fundamental mismatch. And this leads us to the system's greatest weakness, its Achilles heel, the bank run. Just think about it for a second. Banks take our deposits, money we can demand back at any moment, right? That's called borrowing short. But then they use that money to make really long-term loans, like a 30-year mortgage, which they definitely can't call back instantly. That's lending long.
This whole process is an essential function for the economy, but man, is it risky. And this right here, this is the nightmare scenario for any banker. The money isn't all sitting in the vault. It's been lent out. So what happens if confidence suddenly disappears and way too many depositors show up at the same time demanding their money back?
Well, that's the terrifying logic of a bank run. It's a classic self-fulfilling prophecy. If you even think a bank might be in trouble, you have every reason in the world to be the first one in line to get your money out. But if everyone thinks that way at the same time, their collective panic is the very thing that causes the bank to fail. Okay, I know this sounds pretty scary, and historically it absolutely was. These kinds of crises happened all the time, and they led to the creation of a really sophisticated safety net, one that's designed to prevent bank runs and manage all this risk that's baked into the system. So modern banking is held up by a few key pillars of stability. First, you've got central banks that act as a lender of last resort, ready to provide emergency cash if needed. Second, there are government programs, you probably heard of the FDIC in the US, that insure our deposits. That alone removes a huge incentive for us to panic and run. And finally, regulators impose really strict rules and are constantly supervising the banks to make sure they're not getting too reckless. And here's a really important modern twist you should know about. Remember how we used that 10% reserve ratio as an example? Well, get this. Many major economies, including the US, the UK, and Canada, don't even have reserve requirements anymore. Instead of directly telling banks how much to hold back, central banks now manage everything by setting interest rates. They make it either more or less expensive for banks to lend, and that's how they control credit creation. Okay, so let's zoom out and look at the big picture here. What we really have is a financial system that is fundamentally built on two things: credit, and even more importantly, trust. This quote from a top financial regulator, a guy named Adair Turner, just sums it up perfectly. He said, banks create money ex nihilo, which is Latin for out of nothing. It's an absolutely incredible power, a power that finances everything from a corner coffee shop to massive infrastructure projects.
And this really gets to the core trade-off of our entire financial system. It's like a double-edged sword. On one hand, this system is the engine of economic growth. It creates the credit that fuels our entire modern world. But on the other hand, its very design makes it inherently fragile.
So the crucial takeaway here is that our economy isn't built on some fixed pile of gold or a static amount of cash. Not at all. It runs on this incredibly dynamic system where the money supply is constantly expanding through the creation of debt, all managed by this complex web of regulations that are really just there to maintain our trust in it all. I mean, this is the system that has fueled unbelievable growth and innovation. But it also comes with this constant, lurking instability. And that leaves us with a final, pretty fascinating question to think about. Is this incredible, delicate dance between risk and trust, is it the only way? Is it the best way to build a prosperous economy? Or is there another way entirely?